Hey all, welcome to Share Trek. This is Raj here. Friends, I have been having my own thoughts about inflation, but at the same time, I'm very keen to find out when we can expect interest rates to start being cut. I have two main reasons for this. One is from the perspective of our shares, because as the interest rates go down, there'll be more risk appetite and share prices will go up. So that's one aspect. The other aspect is because I have exposure to real estate, especially residential real estate that I give out on rent. And the rents are not catching up with the overall cost of carrying a rental property. So the deficit is keeping on getting wider, and it's just bleeding me. So I want to find out when I can get a bit of relief on that front. So those are the two reasons why I'm on this quest for this information. And I've been trying to validate my own theories with the actual data that I can get from various sources. And in the process, I have looked at other people's estimates as well. So today's video is going to be focused more on answering the question, when can we expect inflation to come back into the normal target range? When can we expect the central bank to start cutting interest rates? So that's what I'm trying to answer. And you will find a lot of data points that I have collected, and you can form your own conclusions and put in the comments what you are thinking about, so that it can again give me more insights. So with that said, let's get started. Well, friends, welcome back. Our inflation woes started during the pandemic. One of the reasons for the pandemic fueled inflation was supposed to be the supply chain issues. This was characterized by huge lineups outside California ports in January 2022. 109 container ships sat off the coast of California, waiting for their turn to unload at the ports of Los Angeles and Long Beach. This meant containers that could have emptied and returned to the source to be reloaded with goods and to come back again sat on board ships waiting to be cleared by the customs and unloaded. And I remember in the early days of the Biden administration, they had put a lot of efforts to decongest the ports, and they succeeded to a great extent. But the fact remains that had the containers gone back in time, we would have had more goods coming in, and that would have eased the inflation. So that didn't happen. And this in turn caused a container shortage, and prices of containers shot up. I remember that in one of my videos, I had mentioned how Amazon made its own containers and used less frequented American ports to unload merchandise in order to try and keep their order turnaround time under control. Because I think Amazon has always been famous for delivering on the same day, most of the things. And they started taking 2 or 3 days to deliver. And that, I think, according to Amazon standards, was not good enough. So they were trying to do all these kind of extra efforts to reduce the turnaround time. Of course, that meant that goods were costing more. Later in the cycle, we also heard about companies diversifying their sources to be less dependent on China, as the zero COVID policies in China were impacting supplies because factories were closed. At that time, the rationale was that the new shipping routes and paperwork is going to take a steep learning curve, and also to negotiate prices for shipping from the new routes would be having some teething troubles. And once that is all done, things will be back to normal. The cost of shipping a 40-foot container from China to America's west coast is now $1,400, down 93% from its peak of somewhere close to $20,600 in September of 2021. In retrospect, the Federal Reserve Bank of New York estimates that 40% of inflation between 2019 and 2021 was caused by supply shocks. The forecast is for the container freight rates to average between 1,000 and 2,000 per box going forward. An IMF study on the impact of shocks to global shipping costs, measured by the Baltic Dry Index, or BDI, on domestic prices for a large panel of countries during the period 1992 to 2021, found that spikes in the BDI are followed by sizable and statistically significant increases in import prices, PPI, that is Producers Price Index, headline inflation and core inflation, as well as inflation expectations as well. The impact is similar in magnitude but more persistent than shocks to global oil and food prices. The effects are more muted in countries where the imports make up of a smaller share of domestic consumption, and those with inflation targeting regimes that are much better anchored and inflation expectations are much better controlled, they fared much better. So which means that if the monetary policy and the fiscal policy work in sync, and there's a well-ironed system of signaling these interest rate changes to the market, and there's a really good market information system, then those countries would do better. Unfortunately, it didn't work for most of the countries. Now let us look at what it means. Now that the freight rates have come down, that would mean that the supply chain issues have been sorted and things have to start looking better and the inflation has to start coming down. It may not happen overnight, but we are in the right track. So that's what I would draw from there. Next, let us look at unemployment levels, which is at an all-time low at this point of time. All-time low unemployment level is always a good thing, but at a time when you're struggling with inflation, all-time low unemployment is not a good thing, because that means many people are earning and many people are going to spend, and as a result of which the inflation will remain stubborn. And the second point with the all-time low unemployment is that there is a labor shortage which is going to be seen, because people are going to be more demanding when they sign up for jobs, and it's going to be difficult to find the right talent, and wages are going to go up. And if wages go up, that means people have more disposable income. So that will spur inflation. So this low unemployment level is something that I'm not very comfortable about. But at the same time, if you were to look at where we were at the peak of the pandemic, we were around 14% unemployment. And the worker shortage was there because everybody was quarantined and the movement was also constrained. And people are working from home and some people didn't have internet access. So to cut a long story short, we have dropped from 14% unemployment. People have started coming back from post-pandemic and they're working. Now the tussle is between how many can work from home and how many will have to be on the site. So that will resolve itself over a period of time. But I think that the business demand for employees has cooled amid rising interest rates and recession risks. So overall, on balance, I think we are in a Goldilocks situation. So it seems to me that this is the perfect opportunity for the industry to introduce robotics, AI, and automation in order to improve worker productivity. Because if there was higher unemployment and industry was to do those kind of initiatives, it would have been politically unpalatable and it would have been very bad from a society perspective. But right now, with such heavy labor shortages and a low unemployment level, this is a very good opportunity to introduce productivity measures like robotics and those kind of things. And I think we are very ripe for that, because we have got AI revolution going on. We have a high level of robotics in place, and we have a whole lot of automation tools like point of sales automation and all in really good situation. So I think we should be able to capitalize on these and try to reduce the labor shortage, and especially in knowledge worker area. And that should keep the inflation numbers down. That's my feeling. And that brings to mind what Kathy Woods has been saying all along, that we are in the cusp of the fourth industrial revolution. And it's about time that the fourth industrial revolution takes off. Chatbots could do customer service. They could also do mortgage qualification. They could do consulting advice on investments and so on. There's a whole lot of things we can do with AI, and that can reduce the worker demand and ease the unemployment situation further, and give a little bit of leeway for companies by reducing the worker shortage. So when all these stars align, if they do, then we should see our genomic shares doing very well. Even those that do not have therapies in phase 2 for a clinical trial, for instance, even they will pick up in value. The risk appetite and animal spirits will return, and it will lift all the boats. That is my expectation. And if I was to come back to the initial question, which was even more fine-tuned, we have spoken in generalizations. My question was, how soon are we going to see interest rates fall? So it seems to me that we are looking at somewhere in 2024 for the interest rates to start reducing. But if I was to look at mortgage rates, I think that mortgage rates should start to fall maybe towards the end of 2023. That is my expectations. But when I speak to bankers out here and ask them, they are all of the opinion that high interest rates are here to stay for the long time. I agree that we may not go to 1.5% or 2% or 0% in the near term, but I think that our normal could be somewhere around 2.5 to 3% rates for fixed rate mortgage for a 5-year term in Canada. That's what I am expecting somewhere in by middle of 2024. So that's what I think is likely to happen. And in the US, I do not know, because the US mechanics are very different as compared to our mortgages out here. And for US, I would like all our knowledgeable viewers to start commenting. What do you think is going to happen in US in terms of the interest rate? When do you think it's going to fall? Because there will be a direct correlation between that and the lifting of Genomic share prices. So please put your comments so that I can get an idea of what you guys are thinking about the inflation prospects and the rate cut prospects going forward, and what is your rationale for that. So it will be a very interesting conversation. So friends, we don't have any new news on the genomic sector at this point of time. We are looking for good news with CRISPR Therapeutics, as well as with Bluebird Bio for the sickle cell disease and the TDT therapy towards the last quarter. So till then, I think we'll have to wait and see what happens. But one thing I can say is that in the genomic sequencing world, I'm starting to see PSEB as an even more strong contender, as Illumina is losing steam. But I hope Illumina rights its ship, or else PSEB is going to be an investor favorite going forward. So I'm closely looking at both of them. And when it comes to bio-nanogenomics, I don't think it has got as much fuel in the tank at this point of time. But we'll keep watching what happens out there. So that's my summary for today, my friends. I'm looking forward to the week starting and us looking at better outcomes and more data points coming up, and more opinion leaders saying that interest rates should start going down, inflation should start moderating in the very near future. With that, I would like to end this video. Thanks and have a great day. Bye for now.